Uh, Good afternoon, learners. So I want to welcome you to this lesson. This is business studies, and we are continuing with our topic that we had started on money and banking. Now we stopped at a point where we were looking at the functions of money. So that is where we are going to continue. So here we were looking at the roles or the work of money, or basically what the money is does. Number one, we said that it acts as a medium of exchange. In this case, we say that it acts as a bridge, a connector for one to get off or dispose what they have and also acquire what they don't have. So money facilitates that exchange. Number two, we see that money also acts as a store of value. So this is where we are seeing that some commodities may not be stored for long, and therefore we might look for an alternative through which we can store them. And this is where we are saying that we can sell them, get the equivalence in terms of money, and then we can store that money for future use. So money helps us to convert assets, and then we can use them in future. The other thing that money does is that it acts as a measure of value. Now, a quick reminder is that when we were looking at barter trade, we saw that it was very hard for us to tell how much of commodity A is worth another quantity of commodity B. But here now, we are seeing a measure of value such that we are able to say that this commodity is worth this much in terms of money. This commodity its worth is this other value in terms of money. Money also serves the other function of being a unit of account. It serves as a unit of account, and in this case now we are looking at, if you want to know the volume of business transactions that have taken place, how will we be able to quantify that? So when we are transacting in terms of money, we'll be able at the end of the day go through the record and see how much has been transacted, or the volume of business that has taken place. Money also serves the purpose of being a standard for deferred payments. Deferred payments. To start with, to defer something is to push it or to postpone it into future. That is, it will be done in future. So in case we have a payment that is not being made promptly and it needs to be made in future, then money can help us gauge and know how much will be paid that time in future. So we are able to give that figure in terms of money. Money also serves the function of moving immovable assets, or rather transferring immovable assets. There are some assets that cannot be moved. An example is something like land. Others maybe are very bulky. It will be very tedious to move them from one place to another. So in case we are involved in such an asset, then we can move them in terms of money. You look at a land owner in Mombasa and they want to maybe sell that land to somebody who is maybe in a different location. They may not be able to carry it all the way to the buyer, and therefore the only thing they can do is to convert it in terms of money right where it is. So basically, those are the functions that we can highlight, or the work that money does. I want us now to proceed on. I want us to proceed on and now look at something else again touching on money, we have so far seen that money is a good thing and it does quite some good work. Not going by the functions that we just mentioned. So you will notice that people will have a tendency to look for money. So the next subheading is demand for money. Demand for money. That is the next thing we are looking at. Going by what money is able to do, or the things that it does for people, then the next thing that we're going to see is that people will be making efforts to acquire or have money. And that is basically what we're looking at here. So demand for money is basically the desire for money by individuals or organizations. The desire that they have to keep money in physical form. Now, is what we call liquidity preference. It's almost a common saying out there when you maybe if you intercept somebody along the way, maybe in their businesses, at the end of the day they might tell you, I'm looking for money. That is liquidity preference. Why do they want to hold on to money? We are going to look at these reasons informed or rather in form of motives. The reasons that people have that they are prompting for money. So there are basically three motives that derive or that inform this demand for money in individuals or even organizations. So let's look at those motives. The first motive why you find people looking for money or trying to hold on to money is what we call transactions motive. Transactions motive. Motive has to do with intention. So they are holding that money with an intention that they are going to use it for transactions. Now, transactions are the activities that we have, the purchases that we have on day-to-day basis, or the payments that are made on day-to-day basis. So somebody will need to hold or to have money so that they'll be using it on a day-to-day basis to meet those expenses or to be able to offset those payments. Now, the amount of money that somebody is going to hold for transaction purposes depends on the following. So you might go to one person, they tell you I have 1,000 that I've kept aside for my transactions. Another person, I have 10,000, and so on and so forth. So what determines this amount of money that you're going to find people have? Number one is the individual's level of income. In short, the earnings that people get. So you'll find that the higher the income that a person gets or their earnings, that might inform the amount of transactions or rather, and by extension, the amount of money that they are likely to hold. So if somebody's income is high, then consequently they are likely to hold a lot of money for these purposes. And the converse is also true. Low income translates to low amount of money held for transactions motive. The other determinant of this is the interval between receipts of money. Between one interval and the next one, when they are receiving money, how long does it take? And you find that, for instance, if the frequency is very small, they keep a lot of money because they know very soon into the future I'm going to receive some more money. But if the interval is wide, then we are likely to see this money or a larger amount of money because they know that between now and going to receive any other amount of money, they need to have quite be taking care of those expenses. Then the other determinant will be individuals' spending habits. So different people have different habits when it comes to spending, and that again will be a determinant here. Those people who ordinarily are higher spenders, then they are likely to have so many transactions. By that, a lot of money here. Those people who are a bit frugal, they don't spend a lot of money, then we are going to see them hold just a small amount because their transactions are not likely to be as high. So that is the other determinant. Next, the price of commodities. Prices of commodities, or in other words, what we call inflation, general price level of commodities. Common knowledge will tell us that if the commodities are quite expensive or the prices are quite high, then we'll need a lot of money to be able to acquire them. And if the prices are low, we may not need a lot of money. So if the price level is high, then we're expecting the amount held for transactions to be also high, and the opposite will also happen. The other determinant is availability of credit. Availability of credit is with which you can borrow money if need be, or in case you have a deficit. Now here we are going to see that if credit or options of borrowing are not so many, then this person will know that I'll have no other alternative in case I exhaust my resources, or in case I exhaust the amount of money that I have. So if it is not easy to get credit, then people will hold a lot of money here because they know they have no other option. On the other hand, if credit is readily available, then somebody does not worry so much because they know in case they need money, they can easily borrow. Finally, is the number of dependents one has. Of dependents. So how many people rely on you for upkeep? So if there are many, that means that also the amount that you use for their sustenance is also high, and therefore you're likely to keep a lot of money, unlike somebody who is just living alone or with just a few dependents. So basically, that is one of the motives why people look for money, or they demand or they desire to have money with themselves. Next, we see the other motive. The other motive, which we call precautionary motive. Precaution has to do with playing safe, or making sure that you're safe in case of something bad happening. So we also have this bracket of things that are likely to happen to somebody, maybe a misfortune, and it's likely to call for money, or they need to use money to fix the problem that arises. So this is the money that is set aside to meet unforeseen occurrences or expenses, something that you not planned and it has just happened, and you have to use money to address it. So especially things like accidents, things like sicknesses, those are things that are not foreseen, but whenever they occur, they call for spending. So somebody might keep aside some amount. Now again, simply this amount here that will be kept in this basket will depend on a number of factors. Some of them now we've already highlighted them. That is the levels of one income, just like we've mentioned. In transactions here, if the income is high, somebody is going to set aside quite an amount for precautionary purposes. The other one is age of the individual. age of the individual in question here. So here we are going to see that the elderly, especially when you focus on things like sicknesses, they are more prone, and therefore they are likely to fall sick, or under normal circumstances they are likely to fall sick more frequently than the younger people, and therefore the elderly are likely to keep more money here for precaution. The other thing that can also inform this is the experiences of life. You'll notice that those elderly people have more experiences. They've seen maybe things occur, these unforeseen eventualities. They've seen so many of them, and therefore they have an experience. They might end up maybe setting aside more than the younger people who probably do not have much knowledge about unforeseen occurrences. Next, this will also be determined by family size and status. About the number of people in that family, and you'll notice that if the family is quite huge, then chances are that one of the members of the family has a higher likelihood of being affected by an unforeseen situation which can call for money, maybe something like sickness. When we have a family of 10, there is a high likelihood that one of the members is likely to fall ill, unlike when we have a family of just 2 people. Then also the economic status of that family. How well up are they as far as money is concerned? So if they are high economic class, then they are also likely to set aside more money for that purpose. The other purpose that you'd also seen was the pay interval, duration between one payment and the next. And the same justification that we used for transactions motive still applies here. We also have individuals' temperaments. Or you can also call these their expectations in life. We can use alternative ones to explain this. What is the person's view of life? There are different types of people here, and we can primarily take 2 categories. That is the optimists and also the pessimists. Optimists are those people who expect that things are going to be okay. They don't expect any nasty occurrences taking place, seeing bad things happening to them, and therefore their expectations are that something bad is in the good. So for the pessimists, they are likely to keep more emotions because the expectations are that things have to go awry. The same when we go to pessimists, as that is the optimists, the ones who see the positive things in life. They don't have to keep a lot of money because they're expecting that things are going to be all right with them. Then occurrence of risks. Now this looks at the history of a place or a certain risk. We find that in case there is a certain risk that has frequently been occurring, that informs into the future that it's also likely to occur, and therefore we need to be more prepared for it if it happens to take place. In that case, these people are likely to set aside more money for precautionary purposes. Finally, the third motive why people hold on to money is what we call speculative. People to hold on to money. And the reason as to why they are keeping that money is because they are anticipating, or they are looking forward to something that is likely to take place in future, more so a business opportunity, and they want to embrace it. They would like to invest in it when a chance presents itself. So people can keep money aside for such a purpose. So this is primarily money that is set aside so that somebody can embrace an investment opportunity that is likely to or rather that is likely to present itself in future. So again, this one again can depend on the level of income. So those people earning more aside more money earmarked for potential investments. The other thing that is likely to inform this amount is the rate of interest. On securities. So this was encountered when we're dealing with the stock exchange. Securities are the investments that are made through the government, especially when we have government borrowing. The instruments that the government uses to borrow, what is the interest against which they are paying? So if the interest of securities is high, that tells you that people will put their money in those investments, and therefore they are not likely to keep more money for investment because they are already having opportunities where they can earn good interest. The same case applies to when the interest on securities is low. Nobody is going to invest in securities that have low returns, so they are likely to hold on to their money so that when a better opportunity arises in future, then they can put their money into those investments. The other reason or rather which will determine how much money we have here are the prevailing economic conditions. The prevailing economic condition. How is the performance? Is the economy vibrant or otherwise? Now, when we have a recess in the economy, that means that we don't have a lot of vibrancy, rather we don't have a lot of activity taking place, and in that case, people are likely now to invest in expectation that the economy is going to peak, and by the time it's going to peak, for instance, the prices of shares will have appreciated, and therefore they are going to get value for their investments. So when the economic conditions are unfavorable, people are likely to invest. Like now we are talking about the global effects of COVID-19. Right now, many sectors are not performing so well, so people are likely to put their money there today because they are looking forward to brighter days in future, and when the economy will be picking up, it will peak together with the investments. Generally, the share price like today, they are very, very low in many sectors of the economy, so people can put their money in there today. Now, having discussed the demand for money, that is the desire that firms, the desire that people have for money, and the reasons that inform that desire, now we can go to the other side and see now something we call supply for this money. Where will this money come from? Supply for money. So when you're talking about supply for money, we are simply talking about the amount of money that will be in circulation, that will be available for use at any one given point in time. So this supply basically is just representing the amount that is available for use. And here we are talking about the total currency in the hands of people. So notes and also coins. people have in their hands. We're also talking about total demand deposits. Demand deposits. So here we are talking about the money that the individuals or the institutions are not now having in their hands, but they have deposited them with financial institutions that you're going to see in due course. They've deposited them there for safekeeping. So total demand deposits, this one will be found in banks or financial institutions, the amount that is in those financial institutions. And we are also talking about international inflows. So this is the money that, or rather the remittances from diaspora, from outside the country, the money that is also coming into the country. So supply of money will aggregate all these components. So we have an institution that is in charge of regulating the amount of money that is in circulation, and that is the central bank. So every economy, or rather simply speaking, administratively speaking, every country has its own central bank that regulates the amount of money that is in circulation. We are going to see more of that when we'll be dealing with the central bank as a subheading. So for now, it's important for us to know that there is an institution whose responsibility is determining and regulating the amount of money that people, or rather that is available for use. Now, that was laying a foundation on this topic on one side, that was on money, and now we are going to cross over to the other side and see what banking entails. Banking. Banking. So banking generally is the activities that financial institutions get involved in the process of handling money. That is simply what banking is all about. The activities of financial institutions in the process of handling money. And you're going to see some few players here, or the institutions that come to play when it comes to banking. So one of the players here in this area of banking are the commercial banks. So these are institutions that have been licensed by the authorities. We talked about commercial, the overall authority in a country, that is central bank. These are institutions that have been licensed by central bank to do a number of things as far as handling of money is concerned. So in this case, or rather in this discussion, we are going to look at the roles of these. What do they do? Their functions. The first thing that they do is that they accept deposits. Deposits. Now, firms or individuals are likely to encounter a situation where the money that they've acquired is more than what they feel is safe being in their hands, and therefore they need to look for security somewhere. So in that case, they are going to put that money in a bank, accept deposits. And we might pause for a while here and look at the modalities that are involved in accepting of deposits. And this money is put in what we call accounts. So commercial banks operate what we call accounts, and there are 3 or so accounts of interest that I would like us to look at before we go to the next function of commercial banks. That type of account. In accounts, different accounts are tailored uniquely depending on the purpose that they want to accomplish. So the first account we call the current account. And here I want to task the learners to be so much in touch with what is happening lately in this area of banking, of the literature that you're going to find in your textbooks has of course been outlived by the latest developments in banking. So make sure that you get the current information in this area. So this is a type of an account where the deposit, the account holder puts their money under a number of arrangements. The first feature of this account is that it uses checks for withdrawal. In case somebody wants now to go for their money that they put in the bank, they are going to use a check. They are going to write a check and present it. They can be given money against the information that they've put on that check. The other is that it does not require minimum deposit. So you'll not be told to retain a certain amount of money in that account throughout. It does not require such a restriction. The amount of money that is supposed to be retained in that account at any given time. So this one can even have a zero amount. The other feature is that it offers what we call overdrafts. So this account provides overdraft facilities. This is another way of borrowing. The account holder can be allowed more money than what they've actually put in that account. For instance, maybe somebody had deposited 20,000 shillings in an account. That is their money in that account. But now a need arises and maybe they need 50,000. So that tells you that their 20,000 is not sufficient. They'll have a deficit of 30,000. So depending on the agreement that they have with the bank, they can be allowed to withdraw more money than what they actually have. So in this context now, we can see somebody withdrawing even 50,000, yet their money is 20,000. That is an overdraft. So this account allows for that. The other thing that we are going to see in this account is that ledger fees are charged. So the bank is going to charge some amount of money for handling or operating this account. So charges, ledger fees. Maybe at the end of the month, something small is going to be taken by the bank from that account in form of a fee. The other feature is that customers or account holders are issued with regular statements. So initially people used to get a printout that is a record of transactions, the deposits that have got into that account, the withdrawals that have been made for a certain duration. Maybe it can be for 6 months, it can be for 1 year, depending on the number of transactions. The financial institutions are able to give out those statements to the account holders. Otherwise, due to the need to cut on costs, nowadays you're not likely to find physical printouts being sent to customers, but banks have gone for alternatives. Maybe they can send in soft copies, maybe a statement in an email, and maybe the account holder can read it from there. The other characteristic, as we tend to wind up, is that these accounts don't earn any interest on deposits. So when somebody deposits their money in that account, regardless of the duration that they're going to hold that money in that account, they are not likely to get any interest on that deposit. Finally, this that deposits can be made anytime. So we don't have restrictions on when one can make deposits. Anytime. Yeah, so somebody can go to the bank when we are in working hours, they can deposit their money. It also doesn't count the number of times that deposits can be made. You can make as many as need arises. Also, with the advancement in technology, we've also seen other platforms that make this possible for people to push deposits into their bank accounts any time of the day. So basically, those are the characteristics of a current account. As we draw to close, I would engage us with just some few questions that you're likely to find from what you've so far covered from most likely maybe paper one, or even paper two. We are likely to get a few questions from that bit. Maybe during your own free time, you can try to see whether you can answer this. Give 5 characteristics of money. 5 characteristics of money. And this one, because we want to be very thorough, try to explain what is likely to come even in paper 2. Explain 5 characteristics of money. State 5 functions of money. State 5 functions of money. What does money do? Number 3. State 5 factors determining amount of money held for transactions motive. What are the 5 factors that can determine the amount of money that one can hold for transaction motives? Yeah, and I want to believe that will be it for today's lesson. I'm wishing you all the best. Thank you so much.